Hey, what's up? Welcome to our channel. In this episode, if you will, I'm going to really dive into those 10 tips that we gave you, the critical things that you absolutely should know before you decide to invest in real estate. Real estate is a very lucrative wealth building tool, but it can be challenging. It definitely is a complex industry if you don't prepare and properly plan. So our goal is to help you to understand some of the critical things and the knowledge base that you need before you start investing, because these will be key factors in determining whether or not you're going to be successful, right? So let's jump into it. So tip number one, location. With every business, location is always a key factor. So why is it a key factor in real estate? Because location is going to determine what your return on your investment will be, right? It's neighborhood specific. And in real estate, neighborhoods have classes. There's A, B, C, D. There's four classes. I had to count it out in my head. There are four classes of neighborhoods in real estate. I'll break it down for you really quick. Class A is the super luxe neighborhoods. I'm talking about, this is the top of the line, creme de la creme neighborhoods. They have the best school systems, highest taxes too, let's not forget that. But these are the creme de la creme neighborhoods. So you need to know if your investment journey or strategy is going to be to invest in A-class neighborhoods, you need to have some money, okay? That's just the fact of the matter. Class B neighborhood. A Class B neighborhood obviously is slightly under an A-class neighborhood, still a very good neighborhood. They still have really good school systems. They still have, they're centrally located normally, where you've got your Walmart, your Targets, and all that stuff sort of within a few miles of the communities. But it is, like I said, a step under the A-class neighborhoods. And just like school, you know how you have an A+ to an A-, that's the same thing that happens in real estate neighborhood classes, right? Classifications. You may have an A+ or an A- neighborhood, or a B+ neighborhood that's moving into an A-class neighborhood. But B is certainly a safe, very safe neighborhood to invest in. Income, meaning that you've got working class families. They're not super rich, but they've got money, right? And they're comfortable. Then you've got your C-class neighborhoods. So C-class neighborhoods are obviously not as good as A and B, right? But C-class neighborhoods are still working class people. You might have a lot of single family households in a C-class neighborhood, where you're only operating on one income. The school systems aren't bad, but they aren't great, right? And it could be, that the people in the C-class neighborhoods are just starting out, right? And they can't afford to sort of be in the best neighborhood, but something near best is where they are. So C-class neighborhoods are actually, and to be honest with you, that's sort of where we like to be, in C-class neighborhoods. But the other neighborhood class would be a D neighborhood. Now, D neighborhood, let me just keep it 100% with you. D-class neighborhoods are the hood. This is the hood. These are where you're going to see a lot of abandoned properties, most likely. School systems aren't that great. Crime may be high, or crime is high in Class D neighborhoods. And you'll typically find a lot of, great deals in D-class neighborhoods, because, there's not a lot of people who are vying to get into a D-class neighborhood. But if you're looking from an investor standpoint, then you want to go where you want to go to the neighborhood that fits your investment strategy. There's an investment strategy in every class neighborhood that I just broke down. It just depends on where you, as an investor, where you want to start, where you're most comfortable. As for us, we like D and C neighborhoods. We like D-class neighborhoods that we can sort of, and let me just say this too before I get back to that point. D and C class neighborhoods tend to be a lot of rentals. There might be a lot of rental properties in D to C class neighborhoods. And we like to invest in those neighborhoods because we are portfolio investors, meaning that we like cash flow, we like tenants, we like that whole side of real estate investing, but we're also fix and flippers, right? So we like to invest in properties where we can get in and get out in a short period of time. And so we look for neighborhoods that have some potential, that have development happening. You see some development happening in sporadic areas, you might want to grab up a few properties. So D and C, we love. For our flip properties, we like to be in the C plus into the B neighborhood classes. And so, yeah, as you get familiar with location, you'll understand exactly what type of investor you want to be and what neighborhood you should invest in. So that's tip number one. Okay, location, location, location. Tip number two, market trends. Why does that matter? Well, market trends matter because everything you do in real estate has to do with the market. You need to know where the market sits so that you can understand what to do in that market. Not every investment strategy is good in every market, right? When there's a seller's market, you need to know what you should be doing as an investor in a seller's market. When there's a buyer's market, you need to know what to do or the best strategy to execute in a buyer's market. So understanding market trends, including your after repair values, that's your sales prices. You need to know what the rent are commanding in a specific neighborhood. This is all going to help you make informed decisions on where you want to invest your money. Okay, so definitely, and I would always suggest, we always sort of suggest as a new investor when you're starting out, don't try to tackle the whole market. Right? Maybe you start in a specific area. It's what we call farming. Maybe you start farming in a specific area, neighborhood, zip code, where you can really just become a master at that neighborhood, right? Master that first and become an expert in that. And that's where you should start investing. But definitely know where the market is. Number three, financing. So you want to consider how you're going to finance your investment before you start buying, right? You want to understand what type of money you're going to need before you start buying. Some people are cash buyers. Some people use, hard money lenders, which are lenders who lend specifically for investment type of deals. Some people are conventional, sort of. Some people, got mom and pop's money from the trust fund. I don't know. But some people, you have to determine what type of financing, if any, and you want to start reaching out to different lenders to just see what programs they offer, what the criteria is that they're going to be looking for as a new investor. Some lenders don't want to lend to new investors. And if they do, their interest rates are higher. They require you to have more skin in the game. There's a lot of different things and nuances that comes with financing. So before you start investing, you sort of want to have a game plan on how you're going to pay for these properties. I always say that if you're new, you should always be looking for someone else to team up or partner with that can bring to the table that which you don't have. So if you are the partner that has all the know-how, like you've been studying, you've been coached, you've been doing all the things to sort of learn the game of real estate investing, but maybe you don't have the money. Maybe you team up with a partner that has money. So there's so many different ways to go about it. But the biggest piece of advice I can give you when it comes to financing is you have to research the financing and go with the strategy that fits your goals. Go with the strategies that fit your goals. Number four, investment strategy. So what does this mean? It means that you have to determine what your strategy is going to be, right? Whether you're going to be a buy and hold investor, whether you're going to fix and flip, whether you are going to invest in rental properties, you just need to know what type of investor you want to be, because that's going to determine all the things we just talked about. That's going to determine where you should buy, what location, area you should start buying in, what type of financing you should be seeking. So to understand what type of investor you want to be, you should know this before going into it, right? Because some people go into real estate investing because they want more money every month. You want more money in your pocket every month. You want cash flow. So that would mean that you're looking to be a buy and hold investor. You want to collect rents and you want to buy properties where there's a lot of cash flow. And some investors want appreciation, right? Well, cash flow and appreciation doesn't necessarily come as a package deal. And I'll explain that to you in a minute. But say if you want to be an investor where you want to just get some big checks, right? Every 4 or 5 months, you want a big check coming in, right? You just want to be able to cash out quickly. You want some short-term investments. Well, fix and flipping will definitely be the type of investor that you become. But again, understanding where your market is will determine whether or not you should be fix and flipping, because not every market is conducive to fixing and flipping. But back to the cash flow and appreciation being one in the same, it's not. A property can offer you cash flow with no appreciation. And I'll take you back to the neighborhood classifications. Remember when we were talking about neighborhood classifications? Let's say if you go and invest in the hood, right? You invest in the hood where you know you may get some Section 8 tenants. The city's going to pay your rent, your mortgage every single month. That's guaranteed mailbox money, or, that's guaranteed mailbox money, right? So you're getting money every single month. It's cash flowing very well. But because it's in that D-class neighborhood, it's not appreciating. Right? So you could have that property can be worth the same thing today and tomorrow and the next year until some real development starts happening in that neighborhood to turn it around. So that's really just a cash flow neighborhood. And if that's okay with you, that's okay. As long as you're getting that check every month or that mailbox money, that's cool, right? So you can be a cash flow investor or you can be an appreciation investor. And most times if you're investing in like Class A neighborhoods, so I'm talking about lux neighborhoods, most of those neighborhoods appreciate very fast, but they don't cash flow, right? They don't cash flow very well. And some investors just want a place to park their money and let it just grow, right? Let it just grow, because they know that year after year after year, those neighborhoods are going to continue to increase in value. So their money and their asset will increase, right? So but the chances of them really getting a lot of money per month for it is not, it's lower than the other neighborhoods. So Class A neighborhoods, not that they can't cash flow, but a lot of Class A neighborhoods don't cash flow more than they appreciate, if that makes sense. All right. So that's tip number 4, knowing what type of investor you want to be. Let's see, number 5, cash flow. I may have jumped ahead a little bit. Analyzing the cash flow potential of the property, including expected rental income, property taxes, insurance, maintenance, and costs. So if you want to be a cash flow investor, this actually goes into tip number 4, because if you plan to be a cash flow investor, those things you need to know. You need to analyze and know what type of cash flow and potential income this property is going to bring you. So how do you know that? Well, you need to know what the property taxes are on the property. You need to know how much insurance is going to cost you every month. You need to know the maintenance cost. What does it cost to maintain the property every month? And you need to understand what the vacancy rates are in that area, just the area overall, and then specifically that property that you're looking to purchase. There's cash flow, right? Meaning there's cash flow. After you pay the mortgage, this is what you're left. You get the rent, you pay the mortgage, this is what you're left with, right? There's that cash flow, right? Just your mortgage, where you look at your gross minus your mortgage equals what you've netted for the month. But that is not a true number. That's not a true number, because if you're only considering your expenses being the mortgage that you're paying, then you have missed the boat on analyzing real cash flow. Real cash flow comes after you've considered all the things that I just said. You've considered your property insurance, you've considered maintenance costs, you've considered how many times out the year the property could be vacant. You've considered all of these factors, and taxes. Did I say taxes? And taxes. Once you've considered all those factors, that's when you come up with your real cash flow number. So before you purchase a property, you want to really understand the cash flow of it and how much cash flow you tend to make, because cash flow, many investors get that analysis wrong. Many people get that analysis wrong because they don't factor in all the other expenses that come with owning and renting property. So understand what cash flow, how to analyze cash flow. Number 6, return on investment. Okay, so return on investment, ROI is the acronym for that. Why do you need to know this? Because you need to know, based on how much money I'm putting in this property, how much money will I get out of it? What will be my rate of return, right? So that's your ROI. Let's just say you paid $1,000 for a property. You made $10,000 by just putting up $1,000. What is your ROI? It's 90%. In real estate, how do you determine your ROI? Well, that's determined by your purchase price, your potential rental income, and it's determined by the maintenance cost and the expenses, I should say, the expenses that you're going to have to pay out for this property. Once you have all the 3 of those numbers, you'll be able to safely determine your ROI. Now, a lot of this is going to be depending on the type of investor you want to become. So if you want to be a short-term investor, you probably expect a higher ROI in a shorter period of time. If you plan to hold for a little while to collect that cash flow, your return on investment could be 5 years down the road. But again, determining what type of investor, which was one of the tips that we talked about earlier, will determine sort of where you need to be in your ROI. Number 7, property condition. Well, before you buy a property, you should always inspect. And you may hear some other investors, more seasoned investors, talk about they make sight unseen offers without even walking through them, without even looking at them. If you're a new investor, I definitely advise you to put your eyes on the property and sort of understand what is going on with the property before you buy it. Because depending on what's going on with the property will determine how you need to renovate it, how you need to rehab it to get it up to par. And whether up to par means because you're going to fix and flip it, or up to par means you're just going to do enough of a rehab to be able to get some tenants in there. So understanding what the property's condition is before you buy it is super important. Even if you yourself can't take a look at it and can't assess it, and you're, say, investing in another market and you don't have access to go to the property just by proximity of where you live, you should have some boots on the ground. Somebody should be able to put eyes on the property. And ideally, it would be a contractor, somebody who can also sort of give you a rough estimation on what it's going to cost to get that property up to speed. So that is definitely a tip that you should not skip over. Know the property's condition. Number 8, legal issues. I can tell you a gang of stories about properties with legal issues. I mean, literally, we have gotten to the table. We have gotten all the way to the table, ready to sign and close on properties, and things came up on title. Unexpected things came up. So to the best of your ability, you want to sort of get in front of those things, and you want to understand, everything about the property. In most counties and cities, you have access to property records. The license and inspection department in each city will show you if there's any violations on the property. So you can sort of do that research ahead of time. If it's not available online, you can go down to the building inspector's department or office and find out if the building has any current violations. In terms of title, if there's any liens or debts and all that stuff on the property, you can have your title company or closing attorney do a title search to determine sort of what liens are up against this property. And again, a lot of this information can be found on county websites. It's 2023. They're now a little more technically advanced in terms of their data, and most of this stuff can be found online. So you can go to public records and see if there's any outstanding liens on the property, and just sort of what type of legal issues may be associated with this property. Some things you won't be able to tell until you have a full title search done, but you can find out who's on the deed. All these things are sort of public records. Try to figure out where the property stands in terms of any potential legalities before you buy so you understand sort of what you're buying. Number 9, tax implications. So you should definitely consider all tax implications when you own an investment property, including the property taxes, income taxes, and capital gains taxes and all that stuff. Because if you're going to buy a property you don't intend to live in, there are capital gains taxes you have to pay. That money that you make from a flip, that big check you get from a flip, honey, those are taxable dollars. That's considered income. And you've got to understand what the tax implication is going to be if you get a $30,000 check. So that's something I would certainly advise you to talk to your accountant, your CPA about, what the tax implications would be when you start buying investment properties. So sort of do this homework and this research ahead of time so that you're not blindsided by it. Because let me tell you something, Big Brother gonna want his money. Trust when I tell you, he's going to want his money. And when you sign that settlement sheet, don't think you're getting away with $30,000 and you ain't paying the I to the R to the S, okay? Because that settlement sheet is a legally binding document and they see that you bought that house or sold that house and made 30 grand. So don't think you're hiding that from the government. So just understand what the tax implications are. And finally, tip number 10 is the exit strategy. So you should never, ever, 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 never, ever get into an investment property without understanding how you're going to get out of it. In every investment, you should always have an exit plan. This is crucial because you want to understand how you're going to be made whole, how you're going to get your money back. Are you going to flip this property and, get a big check and go on and do something else with it? Are you going to rent this property? If you're going to rent it, might you rent it and then refinance it and execute what they call the BRRRR strategy? So always have an exit strategy because market conditions can change, right? And have not just one, but maybe have two. If you're a flipper, it's a good idea if you intend to flip a property that you also understand maybe what the cash flow possibilities could be, because in a market like what we've been in the last, say, 2 years, if you started a flip last year, and this is a real story, we started a flip last June. I think it was June of last year. We just got done the flip, I would say, in December. Okay, we were a little bit over time, over budget, had contractor issues, blah, blah, blah. But we basically analyzed the property in one market, right? And by the time we got finished the project and we went to market, the whole real estate market had changed. Like the numbers we had forecasted last year are totally different this year because the market is different. And so our initial exit strategy was to fix and flip this property, but we've not sold it yet. So we're considering and may have to consider, and I don't want to, but it is what it is, but we may have to really consider renting it, right? So that is not the exit strategy we intended, but based on all the things, it might be something that we have to consider. And so I would suggest in the beginning, when you're going into a project, have not just one exit strategy, but have a contingency to that exit strategy, just so that you are not caught with your pants down and, you can pivot when necessary. Okay, so those are the top 10 things that we think that you should absolutely positively know before you start investing in real estate in order for you to be successful. So I hope that helps. If it did, leave a little comment, like, subscribe, and all the things. Follow us on all social media platforms. And if there's anything you want us to specifically talk about, definitely leave that in the comments too. But thank you so much for listening, and I'll see you back next time.